Hey folks, welcome to Pro Trader Strategies. My name's Eric Wilkinson, and what we're doing here is a webinar on swing trades. Well, yeah, we're going to start out talking about swing trades. That gives us the setup as our directional assumption. So we'll talk about that briefly, and then we'll build on that, finding option strategies that best suits that directional assumption and that underlying. What's going on around that underlying? That is particularly important to me as a trader and as you are as well. Remember, when we're looking at this stuff, we need to understand whether or not options are cheap or expensive. That is the key, and that is one of the things that I want you to take away from this today. So when you find that light bulb moment, make sure you guys are smashing that like button for me. That feeds the bots, tells them to run out there and find a person just like you to share that information with. So please help us out with that smash button. Smash that like for us. All right. So like I said, without further ado, let's get on with a little bit of this. And we're talking about swing trades using options here. These are more of the exotic strategies, all right? Not the ones that we usually implement. They're great because of some of the intricacies around that. And I'll talk about those in detail here today. But further, the option strategies, they increase our probabilities of success with these setups. You know, when you're using a stock, an ETF, a future, well, you're beholden to that market move. Well, with this trade, we can actually be directionally wrong and still make money. That's the key to trading options, is you don't always have to be right, folks. We can be wrong and still make money when we're trading options. So that's what I want you guys to learn here in this video. Throughout this, though, make sure you're commenting. Lo-o said hi. So comment, drive this content over to the side. All right. So over there in the comment section, I'll be keeping my eye out over there, making sure if you guys have any questions, we will cover that as we go along. Make sure you guys also, I do daily videos also in the mornings where I'm talking about spotting different trades. Check those out. Hit that subscribe button right next to it. There's a little bell on YouTube that will send you a notification whenever I pop in here. So sometimes I pop in when it's not really scheduled and when I'm talking about different trades. So I want you guys to be able to participate in that as well. So make sure you got that bell lit up. All right, so let's get on with this. Let's set up our trade or our window here so I can kind of see here. How's that look? All right, that looks pretty good. Let's move on here. Get on with the show. So like I said, with this webinar, we're going to start out talking about swing trades and how we kind of see those building up. That's what we're going to base our strategy on. We've talked about the bullish, we've talked about the bearish, and we've talked about the market neutral. These are all of those as well because they are exotic. I've kind of compartmentalized those. So we've talked about bullish, bearish, and market neutral strategies in this section of the swing trade webinar series. So it's not all directionality based where we're saying today we're going to be talking about bullish, or this section we're going to be talking about bullish moves. No, we're going to kind of sprinkle some of them all in here. Last week we did the ratio call spread. Now we're going to be doing the ratio put spread. Could be set up great for this type of scenario that we're looking at for in these. You're very welcome. Thank you very much for the kind words, Oleana. All right, so first I want to talk about the swing trades though. And then we will talk about layering on a strategy around that assumption we come up with from our charts that we're going to be looking at. All right. So first off, what is swing trading? Simply swing trading from the bat, right off the bat, we're just talking about trying to capture a momentum shift in the underlying. All right. They don't always trade in one direction. We don't just see a straight line, right? We see the markets ebb and flow, if you will. And that's what we're trying to catch, is those ebbs and flows. So when we're talking about a swing trade, ultimately we're talking about a bullish move, right? Where the market rallies, a sideways move, just a market neutral type of underlying. There's a lot of them out there, believe it or not. And then a bearish trend. We have all of those all the time. It's not always a bull market everywhere. Sometimes there are bear markets, and sometimes when we're in a bear market, you can find bullish trades. But first thing is we want to determine the overall trend, whether it's bullish, market neutral, or bearish, right? That's what we're trying to determine first. And then we kind of glaze our eyes and look at this chart and see how the ebbs and flows work in this underlying, okay? On all the underlyings that we're looking at. So we can see this, all right? Now, that's the overall trend still. The next thing we need to do is try to figure out where it loses its momentum to the upside and gains support when it sells off. Those are key points for us to take advantage of. So the idea here is to hit as many tops as you can. And I would suggest that if you have if you're newer to trading, to pick the further away points. And if you're a little bit more of a savvy trader or a veteran trader, high risk tolerant person, then go with maybe a little bit of a tighter one. So for me, I would say I would look at something like this as support and resistance to try and make sure I captured all of those. Another thing is when the market breaks out of that support area and comes back into that area, back into that trend channel, that's really an area also that you would be wanting to look at. So for instance, on this one, you could look at the resistance and the support and the resistance, okay? So first step, find the trend. Second step is to try and find those support and resistance areas where it's capturing the momentum to the downside, where it's picking it up, and then selling, pressure starts happening. That's when you want to take advantage of the downside move. Now, the last thing we need, it's a three-part step, right? We did the trend, we did the support and resistance. Now we need to find the pattern within the trend, all right? So for instance, this is a neutral trend with a bullish pattern setting up. We've got a bullish trend with a bullish pattern, all right? And a bearish trend with a bearish pattern, all right? So the pattern is what we are going to key our trade off of, all right? Nothing else. We're going to look for this pattern, and that's going to really give us the indication as to a bullish or bearish market move, right? So that's what we're trying to find with just finding those trends. So that's the simple concept, folks. I'm going to try and build from simple concepts to real life examples throughout this. So here is a real life example, right? We've got IBM here, and yes, it is a bit of an older snapshot, but we can see with Fibonacci's, or just without even these Fibonacci's, you can see where it loses the momentum to the upside and gains support on the downside. For maybe the lower risk tolerant person, this is the area I was talking about. You try and get that further away one. A higher risk tolerant person might pick one a little bit tighter, pick their own, like it looks like there's one right inside of there, right? And that would line up with this tighter one. And then maybe the lower risk tolerant person is going to pick, or the newer trader, pick something out here as your line in the sand for your support and resistances. Remember, if you're further away, that's going to be a less risky trade, if you will, because it could have more room to the upside or downside with some of these other ones that are a little bit tighter like this, okay? I usually pick the little bit tighter ones myself. And then, so we've got a sideways trend. We found those support and resistances really easy, right? And then I said we would look for a momentum shift. So when we're looking for momentum shifts here, folks, what I want you guys to do is look for certain types of candles. And they are, I still have my pen, don't I? Something that looks like this. We'd call those like a hangman doji. A hammer doji is just the flip of it, right? And then you can have like a spinning top doji where it looks like that. It's got a little bit of a wick. And then, there's like a tombstone doji. Very rarely see those. But these are the key ones to really be keeping your eyes out for at the top and bottom of a move. It can't really be inside the move. It can't really be somewhere right along where this point of control is. These won't really carry much weight in here. You can find one there at the bottom of that little move, but what I'm saying is, say for instance, something like that in there, in and around these little areas, isn't going to hold as much weight inside of these base areas, or like this one right here. It's not at the very top of a move like we're seeing here, okay? But they can be in green as well. So you're not always just looking for the red ones. So I have mine filled in on some charts and sometimes I don't, but it doesn't really matter. It's green or red. We're looking for any of these types of patterns. You can have a shooting cross like that at the top, or the, again, the doji. Really what we're trying to do here with these dojis, the idea here is you're watching for the bulls and the bears to battle it out, and whoever's losing the momentum is losing the battle, right? So here we could see at the top of this move, and because it's very close to our resistance area, that would be a very good strike location to get involved with an underlying. So those are what we're looking for in moves where we're looking for these types of candles at the tops and bottoms of a move. That one's a little bit stretched out a little bit. Here is a different type of pattern that we probably wouldn't have even had a trade off of, but you can see they're showing up in several different places. We can even find it here in the S&Ps. I've used this example throughout the year as a very good support area. One thing to notice is we've moved down almost a full measure, and then I just threw this line up there yesterday as a bit of a support. Something we can notice here is this is a neckline that I talked about this morning in the spot the trade video. But again, got a nice little topping pattern there. What we would be looking for is the next day, which was today, because I took these snapshots yesterday and was pretty sure we were going to start seeing some red candles here today, and got a bit of a confirmation today if we pull up today's charts. But then we're looking for this market to roll over. First spot would be right along this line somewhere, would be where I would expect us to find some support. And if it breaks this support area, I'm guessing that the next line is going to be to come down and tag that neckline, okay? That's what we talk about with swing trades and setups. Like this is a pattern setup. It's called the head and shoulders. The idea is you got a shoulder here, you got the head there, and you're building another shoulder here, and it usually sells off to hit that neckline again. Or it could break down, and another way to look at it is you have a measured move from this point, so that measure from here to here would drop you down to about there, okay? That's a little bit more technical. I'm just kind of spacing that out a little bit, but something like this, you could look at setting up a trade for a bearish move to come back down to the 50-day simple moving average or this trend channel. Make sense for everybody so far? Might have gotten a little bit advanced there, but the thing we're looking for are those candles. Now, why would we want to use options? The reason why we want to use options is because you have better odds. Sorry. It's probably going to take me 10 years, folks, to figure out the fact that the new PowerPoint, you have to click on the pin every single time. All right, so why options? Well, first one is you have better odds or better probabilities. I'm not going to write out probability. I'm just going to write odds. You have lower margins. I don't care what you're doing. You're going to have lower margins using options than you are any other way. I even showed if you go long a stock, you can use options and still use less money. Even if you're trading in a margin account, you're trading stock in a margin account. I have strategies that I teach that can act exactly like the underlying, other than paying you a dividend. It will act dollar for dollar like that underlying though. Lower margins. You're also going to just know your risk. Know your risk reward right away. A lot of these strategies are defined risk strategies. We can see where our break even is on this. Where's your break even on a stock? It is the price you bought the stock. That's not necessarily the same situation we have over here in options. Sometimes, like I said, we could have an underlying move in our face. And I talk about this, folks. I'm probably not one of the best people to pick directional assumptions all the time. There's people out there that say they do. I would like to see their record, to be quite honest, but I'm not going to ever tout that I pick the best directional moves. What I do tout, though, is the fact that I have higher probabilities of success than anybody else, and I leverage those with the options. I know I have better odds with the options, and I turn the tables even a little bit further, because what I do is I show you how these strategies should, when, where, and why they should be implemented. And a lot of it has to do with the pricing of these options, all right? So remember in the last slide of IBM, This was the line in the sand we were looking for. And because I'm usually more of an aggressive trader, I usually pick not off of the setup, because this is the setup bar. The confirmation never happened. I usually do it on the setup, not the confirmation. I usually get in a little bit early. But you can see the market just ripped like a rip your face off rally. We used to say that was because you were sitting there doing this the whole time. It was like going up your face when you're short or something, okay? Rip your face off rally. You just can't wipe your face enough. But with a stock, my break even is that point I put on the trade. Now, the market rallied up. I would have been stopped out right above that wick. And that's usually the rule that most people say is your setup candle is your out. So whatever that is, this was my setup candle. That top of that wick, a settlement above that would mean that this strategy is blown, or the technical setup, the swing trade is out the window. Well, when you're using options, one of the things, this blast off to the upside caught me a little bit off guard. I'm not going to lie, but I was short the 137 calls. Now you can see I did get tested on that for a day. When it broke up through that Fibonacci, it just happened, boom, boom, and it was right against me, but it rolled back over. So the options not only help you with your margin, help you know your risk reward, keep your powder dry because you're confident, you know you're going to have better odds, but you can stay in the trade a little bit longer, because even with short calls, a directional move against me could be actually a profitable trade, depending on how we set it up. With this trade, I had really high implied volatility, meaning those prices were super expensive. A lot of times when we see the market moving higher, especially slowly, we will see that volatility come out. And if that volatility comes out of those premiums, that means the pricing goes down, right? And when I've sold a call, that means I've sold it first. I collected a credit. I want that value to go down so I can buy it back for pennies on the dollar. So when we're trying to set these strategies up, we are very conscious of the price in the options, okay? If there's nothing you guys take away from trading options other than the fact that you need to know if the pricing is expensive or cheap before you put on a strategy, dude, I have done my job. Like, that's all I really care about, is whether or not, I don't want you guys getting involved in a situation where you're buying options that are super expensive, because you could be directionally right and lose money in that situation. I don't want that to happen ever. All right. I want us to be wrong and make money. Is that a sales line? Hey, if you like that idea, smash that like button. All right. So, this is an updated version. Something I always talk about with IBM is this is the stock that I got started trading around. Why? Because it does what we're looking at. It never, even since 1992-ish, IBM's been trading right around 100. Okay. And I'm not aware of any stock splits. So IBM just never goes anywhere, despite the fact that they have innovations and patents and everything else. They are just stuck here at 100. Now, you might say, hey, Wolfman, and blast it off to 137. But one of the things I like about this trade is this underlying is it's great to get involved, especially for a market neutral assumption, because it likes to stay in this range for the last 20 years. It's probably going to stay there for the foreseeable future, but that's why I like trading around it. It gets up around 136, 135, basically down to 100 is your zone in IBM, probably for the foreseeable future. So I like to play it when it gets to those extremes. And we stayed in this trade. It started rolling back over. It actually rolled back over quite a bit, but we ended up getting out of that. So, actually, it rolled over afterwards. So right here is around where we were talking about. It came out with their earnings. Everybody finally started saying they're happy with IBM's earnings. There's those two tops that we were talking about, right? So we got out of that trade on the rollover on their earnings. Everybody finally started saying that they're happy with Azure, web services. I've been talking about this for years, you guys. If you've been watching these daily videos I do, and how I love IBM. I think they're a great company. They've gone from a service company to, well, they're still a service company, but they're more trying to focus on the cloud services, which is high margin, versus their services, which is low margin. And for some reason, the street wasn't liking that. And I was all on their bandwagon for a while there. But I haven't played in IBM for a while. But you can see it did get up quite nicely to 152. But what did it do? It rolled all the way back over to these buy zones that we've been talking about from the previous time. So if you like IBM, this would be a time for it to start moving back up to the mid, probably eventually to 135, and then it's going to roll back over to 100. I don't think we'll probably see these 150s anytime soon, but the play here would be to watch this start to move higher. I don't have a trade in there, but I do like Netflix. And again, I took these snapshots last night because they were the setup, all right, on the setup candle. I told you, what was I looking for? Hangman dojis, hammer dojis, right? Well, this is a very good example of a hangman doji right there. Well, pretty good example. So that type of pattern. What are we looking for the next day on a pattern like, or on a candle like that? Sorry. The ratio put spread. No, we're looking for a confirmation. We're looking for the candle to finish below the previous day's wick. That's a confirmation. Now, I usually set up on this trade. All right, on the setup bar, but I have a higher risk tolerant trading profile. If you have a lower risk tolerant trading profile, wait for this candle to confirm the downside. All right, I like getting in a little early because you get a couple extra dollars generally. All right, so with this trade, let's just go through my assumption with this. I am bearish. I believe this market is going to come down probably to at least this area right here, because that's the value area high. 590 is what I'm going to call that number. So I think that with this rollover, I think we're going to roll over and at least test this low and probably pierce it just a little bit. So that's my theory on this trade. Now, worst case scenario, I'm looking at it to come down and test this Fibonacci, all right? And that's lining up with, let's call it 570, all right? So I've got a couple of support areas here that I'm looking at for this market to roll over to, all right? So I don't think it's just going to fall out of bed forever. I actually think it's going to be more of a technical setup where it just kind of rolls over, flush out some of the weaker hands, come back down to this point of control before resuming higher. So with Netflix, looking to take advantage of that type of move heading into their ahead of their earnings there. All right, so I'm going to look at the ratio put spread because I don't think it's going to continue on past those levels. I think it's going to come down there and kind of tag it and stay. It might break it a little bit, but I'm not too concerned about that. What I do want to have is this ratio put spread because of the fact that I think it's going to stop right down there in and around the level where the value area high was, that 590. So I believe it's going to go from where we are now, currently around this 630 area, down to 590. I think we're going to have a nice little sell-off there. But I don't think it's going to continue. And that's why I want to do the ratio put spread. I want to take advantage of this bearish move, but I want to layer onto it a little bit so that in case this market jukes back and shoots higher, I don't lose any money on it. Remember, if you're doing a long put spread, right, take advantage of a bearish move, well, you pay a debit for it. So if the market goes the wrong direction, or at least from what you thought it was going to do, well, then you lost all that money. Well, with this strategy, we're going to try and take advantage of a bearish move, but I'm a little bit worried about that upside risk. So I want to sell another call in there, pay for my entire spread. So I have this long put spread on for free. Yeah, I have a little added risk to it. But with that little added risk, I get this spread on for free. So if the market rallies, I get to keep that credit. So another thing is, if there's nothing else you take away from this, if you have a ratio put spread, you have to have a credit. All right. You can do this trade for a debit, but it doesn't make sense to do this for a debit. And this is something I forgot to talk about last week, folks. So hopefully some of you folks that were here last week are here this week, because the reason why we have to do this for a credit is because we're adding on that layer of risk. And there's no reason to add on a layer of risk with this strategy and then still have risk in both directions, right? Because if I don't pay off, if I do this for a debit and the market goes opposite and starts rallying, because this is a bearish strategy, if the market rallies higher, I'm going to lose that debit. So I've added risk to both sides then. So when you're doing a ratio put spread, you have to try and build it out so that you want, or that you come away with a credit or at least a scratch, meaning no change of money. All right. Great question. Alina is all over this. Do you implement this strategy when the implied volatility is high or when the implied volatility is low? That's a great question. You're a little ahead of me, but one thing we do with this strategy is we look for implied volatility. That's a great question, because if I have a bearish assumption here in this underlying, thinking it's going to roll over, a long put spread would be implemented in a low implied volatility environment, right? Because I'm paying a debit. With this one, I've got high implied volatility, so a long put spread doesn't really work. But with that long put spread, if I sell that extra put on there, that high volatility will allow me to pay off the entire spread. Now, you can always set it up in low volatility as well. Know that the spread will be tighter. That's why I like to do it in high volatility, so I can get a really wide spread. And if I can get a really wide spread, then that means that short put way down there, that extra short put, is really far away. So the idea, anytime volatility is high or low, when it's high especially, we expect that volatility to really come out of it. And if the volatility comes out, well, we see all those premiums shriek up, and that will help us with this strategy as well because of that extra short put. Great question, Olian. So we want to do it with high volatility, despite the fact that we're building it out as a long put spread and adding on that layer of risk. It's the best way to say it. So another thing I wanted to show here is back here, you can see this top here and this low. If I draw a line in there, you can see that they are almost at the exact level. They're pennies away, like 70 cents, I think, away from one another. I can't remember the exact low on this one. I think it was like 95 even or something, and this was 94.25 or something. I can't remember exactly, but they're very, very close, and you can see that it has acted as a support and resistance. So another thing layered onto this little level down here, that point of control may seem a little bit like, hey, points of control really aren't massive support and resistance areas. Well, no, you're right. But it is usually a target. And with this added layer of support and resistance, I'm pretty confident in my 590 strike that I'm looking at for this strategy. David's asking, what do we need to choose the strikes so that the Vega and Theta and Delta counter the high implied volatility drop to benefit? Well, there's a lot going on there. Let me dig into this a little bit. All right. So the high volatility makes the premiums really expensive. All right. So they're really pumped up full of premium when the volatility goes higher. And the reason why we know that is because as one of the rules, it's kind of like geometry. Remember with geometry, you had to remember these rules. Well, I'm going to make you remember a couple. When we're talking about the options, anytime we're talking about Delta, Theta, Vega, all right, the assumption in the option montage, or the place where all of the options are, it's an advancement of one, okay? So that is every time volatility increases by 1 percentage point, our premiums increase as well. So when we know a couple of things we know about an underlying is that they will have a tendency to have a range, a neutral kind of market trend, if you will, where they'll find those support and resistances, and you can really see those pretty easily. Even here, you can see where it loses momentum to the upside and gains a bit of support to the downside. So we want to capture that range and then find out where we are right now in time, right there in time, to determine where we are from the high to the low, all right? So you can see it's relatively elevated from that high to the low right there, okay? So we know we have high implied volatility. Now, when volatility goes down, we know that those premiums get smaller and smaller. Well, as that volatility comes out, that means that our spread will become more valuable, all right? Because of that extra short calls. Our short put spread will become more valuable because of that extra short put. Catch me if I'm misspeaking. Sometimes I start talking and I may say calls when I'm at puts. I don't know why, but that could happen. All right. So one thing before we get on, this is a long put. So if you are getting involved with a long put, I'm just, with these next couple of slides, I'm going to show you the build out of this strategy. But I also want to briefly touch on what I was talking in the last slide, where we were talking about, here are the puts. So we got the puts and we got the calls. But here's our Greeks. All right, that we were just talking about. I'm not going to talk about gamma right now. All right, so all of these Greeks are on the advancement. So delta is talking about plus $1. All right, theta is plus 1 day. All right, and vega is plus 1%. All right, so when we're talking about delta, it's a dollar higher move in the underlying. So if this underlying moves higher by $1, our calls will increase by that amount. Now notice over on the puts, our puts have a negative delta, because when the underlying moves higher by $1, our puts will go down in value, all right? So another thing with math here, remember what happens when you add a negative to a positive? Well, it becomes a negative, right? So if we said the underlying was moving down, well, down $1, if the underlying moved down $1 or negative $1, right? Then this, a negative plus a positive, makes this into a negative. So if we started moving down, then our calls would lose value, and a negative plus a negative plus a negative equals a positive, right? So then that, as we move down, those deltas become positive for the puts. And theta is the assumption of 1 day. You'll notice theta is negative in all columns because nobody has a DeLorean that goes back in time. So we are always negative on theta. And vega is for this number. Vega, you guys, is just implied volatility. It's just a fancy name over here in the option montage. And I call this page the option montage. If you ever hear me saying it, this is what I'm talking about, because it's got all this stuff going on in it. But vega is just implied volatility. And you will see implied volatility in more places throughout your trading platform. But over here in the option montage, they tried to be cheeky and name it a Greek, and they couldn't even come up with a real Greek. But so volatility, as it increases, we would see this premium go in there. But we know from the last slide that that volatility is really elevated, right? We can see that it's up at the upper end of the range. So therefore, we can come over here and say these premiums over here are really expensive, right? Because we know we have that high volatility, we know that these premiums are the most expensive they've been. Well, a couple of days ago, they were a little bit more expensive. Volatility's come out in that chart. You saw that. But they're still, for the last 52 weeks, pretty expensive. All right. So therefore, that's why we're starting to lean towards collecting a credit, because we want that big credit, right? We want that big, fat, juicy premium. Well, with this move, the thing with big premiums affecting these at the money options over here is that they're pretty juicy. And therefore, I can make my spread really wide, a long put spread really wide, to to meet my rules, remember, what are my rules for a long put spread? Risk one to make one, right? But we do that when it's low volatility. When it's really high volatility, the spreads get really wide, which is good, but you're also paying through the nose for that strategy then. So for instance, when we go over to the long put spread, if I did the 630 to the 590, you would see that the put spread is basically close, a little bit better than risking one to make one. It's a $40 wide and I've got $15. My rules risk one to make one. But I paid a debit. It's a really wide spread, a little bit wider than normal for a long put spread because of those premiums. And I'm paying $15. But we wouldn't want to do this in a high implied volatility market, right? Because as volatility comes out, right, as volatility starts decreasing, our premiums are going to fall out of bed, right? You can see that those premiums are going to really start eroding. And on a long put spread, that would really hurt this strategy. So I want to stay away from that. But I'm looking at this spread going, man, if I could get that $40 wide spread as a long put spread, that would be a really good trade. So what I want to do, anytime you're setting this strategy up, start out as the long put. Look at this premium that you are looking to buy. And now you have to think, I have to pay for that free premium with a sale. So that's why I picked this 590, because I can see if I sold two of these 2 times that price would make that a credit, right? Or at least pay off all of that. So the extra short put will balance out more than needed the Greek efforts. Well, we do want the Greeks, particularly Vega, to start going down. Another one we want to worry about, or we want on our side, is this theta. Darn it. Theta we want on our side also, right? Because if I build this out as a credit, I want that theta to erode those premiums. So with theta, I want to take advantage of it by getting closer to expiration here. 45 days is that wheelhouse for volatility for theta to start really ramping up, all right? Further out in time, he's not so aggressive. And that's where we want to be buying options, doing long put spreads way out in time, maybe 70 days out. But when we do it for a credit, or we want to take advantage of high implied volatility, well, we want to get all of these Greeks on our side so we come in a little bit closer when we have high volatility, because volatility coming out makes those premiums go down. And then we add the thief in the night, theta, thief in the night, to come and steal our premiums. More and more he erodes those premiums, the faster this strategy works in our favor. Does that make sense, John? All right. So here we've got the put spread, long put spread from the 630 to 590, $15. Now, if I sell another one of those, I'll be able to pay it off and get a credit. So you can see I've got this as I'm long one 630 put, short 2 590 puts. That's right there at that support level I was looking for, right? And then that extra short put only starts hurting me really after we go below 590. So then below 590, that extra short put will hurt. But remember, I still have that long put spread, the 1-by-1 long put spread, 1-by-1 long put spread, I should say, that as every dollar goes down, that put spread gains a value, right? And if I go below 590, that means my long put spread is full value. From 630 to 590, it's gained in value. The entire value, right? Because I didn't pay anything for that put spread. But every dollar below 590, that extra put is going to be hurting my put spread, right? It's going to erode some of those premiums out of it. And I'll show you a little bit more about that here in a second. But one of the things I want to talk about here is we start this out around a 50 delta, all right? And then I'm going to go out to around the 30 delta to define that risk. And the reason why we do that, that's usually right around that risk one to make one scenario. and then we layer on top of it the extra short put, all right? So when we're talking about that in terms of bell curves, one of the things we talk about, this is 0 right in here. That's the start. So this is basically, if you're looking at this line here, this is basically a 50 delta, all right? So when you're looking at this bell curve, you might be thinking about it as percentages and stuff like that, but just know something about delta is data. It gives us all kinds of information. And when we're looking over in the option montage, we're looking at deltas. Well, deltas are just probabilities on a bell curve, okay? That's really what it is. And the bell curve is both on the calls and on the put side, really. But if we wanted to make it look like one side or the other, we're going to be looking at this side being the put side. We'll say this is the puts and this is the calls, all right? All out, we'll say that's out of the monies, all right? If we just had it on one side, half the bell curve would be in the money, half the bell curve would be out of the money. So this is the one that we're going to get long. And then I talked about getting around that 30 delta. That is the half standard deviation. So this is where we sell 2 puts. We're going to buy 1 put here and then sell 2 puts. Now this distance is that put spread that will gain in value, which will give me all the way to here for my break even. Because it's basically an equal distance away, all right? That put will start helping me. Oh, I know what I wanted to do with this. Why did I put up a blank one here? Because volatility affects this bell curve. Now, we just looked at a pretty good bell curve. There's your risk reward. All right, so a normal distribution bell curve. Let's just say it is, let's see if I can draw it. That's about a normal distribution bell curve. And I usually say, it's probably going to cut it off, that this bucket is halfway full of volatility. All right, that's a normal distribution. You got a bucket of volatility on top of your bell curve. Now, if that bucket of volatility gets really heavy, this same bell curve where, you know, like we're looking at standard deviations, let's say this is a 1 standard deviation, a -1 standard deviation for the puts, right? Now, the next one, we'll say it's got a big bucket of volatility on it. Well, that bell curve is going to kind of look like this, all right? Where here is still the middle. And now this bucket has gotten really full, almost to the top. And now our 1 standard deviation is out here, a little bit further. That's what happens here with bell curves. And then if the bucket was empty, our bell curve would look like this. This is our empty bucket. And our 1 standard deviations might be way inside here. Okay. So it's really probability. So when we get high volatility and we can get that standard deviation really far away and that volatility comes out, well, our standard deviation curve snaps to looking like that. Boom. And now the probabilities of going this far are the same probabilities that you started out with way out here. So that's what we're looking for volatility to do. Once that volatility bucket empties, the probabilities of a bigger move become narrower, all right? So we try to take advantage of it when it's really smashed down for this type of trade. And this is our risk reward. So we can see where we're starting right here in the very middle. When we implemented this strategy, we can see that we would make the most money starting off right here when we put on the strategy. Sorry, I'm trying to get a pen in there. So when we put on the strategy, these are the 630 puts, right? Right in there. Now we will gain the most value at 590. Why? Because our long put spread here, which we got the long 1 put and short 1 put, right? 630 to 590. That 1 put spread that we didn't pay anything for will be worth $40. when it's trading 590, right? Because I get the full value of that long put spread. I didn't pay anything for it, so I don't have to add it in. I get the full value of that. Now, the short put hurts after that 590. So you can see that after 590, my profit starts going down. And it starts going down because of that short put, and the long put spread is losing some of its, or it's block everything out I just said there. The long put spread retains its value, but the short extra put is offsetting it. All right. So you can see as we start going down, that long put starts hurting it, and we hit our break even right there, $40 lower from 590 to 550. So our break even here is really 549.43. So our break even is $549.43. Why? Because I get that $40, right? That gets me to 550. And then I also still have this credit that gives me a little more wiggle room to the downside. Okay. So that puts my break even way down there below where those support levels were. All right. So I would be happy to take that trade on, even if it went down to break even. That would be just a massive move nobody was expecting, really. And then you can see if the market rallies higher, the price is going higher, right? I get to keep that 57 cents. It's mine, no matter what. So even if the market rallies, the put spread's going to expire worthless, but I get to keep that credit. So directionally wrong, got 57 bucks. All right. Better than a kick in the pants. It goes down, I can make my money. It hits that support level, dies out there. I would be really happy for that. Does anybody else have any questions before we move on there? Does that make sense? I know I got a lot of writing on there. I probably did this a little bit more justice than the ratio call spread from last week. All right. Before you go, this is what you need to go with. We got 15 hours of content. Actually, it's more than 15 hours of content. Protecting your portfolio against rising interest rates. I talk about this till I'm blue in the face. Nobody ever listens. I don't know why, but you know what? They'll be talking. This is going to be ringing bells in people's heads for the next 5 years when they start seeing their portfolio get decimated from those rising interest rates. This is also another link here. Hold on a second. This is everything you get. This is the rising interest rates, how to protect yourself against that. Folks, it will really hurt. And just watch that one video. It'll open your eyes. You will start trading more bonds. I can guarantee you. I probably guarantee you that. So that's a great one. I didn't talk about much gamma. There's your gamma one. Jump on that because that's a lot of great information. And I've got other strategies for income generation you guys should take advantage of. For 36 bucks, folks, if you did a ratio call spread or put spread with low volatility, it would have cost you more than $36. So help me avoid that angst with you. You know, when you're making all those mistakes by doing things silly without following these guidelines that I'm trying to set you up with here, you know, folks, that's going to cause you to be not as confident in your next trade, which will affect your entry and exit on all of those. So what I'm trying to do is give you the knowledge to be confident in your decision-making process here as to whether you're buying or selling options, and even what option strategy should fit your thought process. Like, go through all of the details. With this one, I think there's a downside play here. I'm not sure about the upside. It has a tendency to rip up there. So if it does, I don't want to lose all my money on this, you know, directional assumption. This way I can keep some money even if I'm wrong. You can, Eric, so you can get out for a credit and then get out for a debit or another credit. Yes, you would be getting out for a higher credit, but when you get out of this trade, that it's a little bit it's a little bit waggy. It's going to give you like a negative credit, really. But really what happens is you've got the money from the long put spread. So that's a credit. And then you're going to get the extra credit for the extra put. So it's going to look like a bigger credit, but it's going to make it a negative credit that gives you the money, if that makes sense. All right. All right. So thanks, guys. You know, last thing I want to say is thank you, guys. I appreciate all of you guys. There's nothing more. I mean, I take a lot out of these. I love the fact that you guys are becoming traders and options traders, because I think that options traders have the best chances of long-term survival trading. All right. So that's why I'm really happy you guys are doing this. And if you guys had anything to take away from this, please share this with everybody else. Share this with your friends. Smash that like button. That feeds the bots to run out and find somebody like you to share this content with as well. And subscribe, hit the bell, all that jazz. I appreciate it. Quick question. I got you. What you got, John? Thanks for the share. Appreciate you. Thank you. Appreciate all the kind words, everybody. How long is your question, John? John's got a question for us, folks, so you can stick around. This is extra content for everybody. Banu, what were you talking about? Max gain at expected move? Yes, max gain at expected move is at that 590 area, if you're still on here, Banu. If it comes down to that 590 area that we talked about, that would be your max profit, because you would get the full width of the spread plus the credit. All right. I guess I'll just go to this one. Right. So 590 is the max profit you can get on this trade. And it would have to settle like 590.01, right? Because the 590.01, then that short put finishes out of the money. You're welcome. All right. So at the 590 strike, if the stock stays there, we would close for a credit for $40 plus the original credit. Yes. Okay. But if you do this for a debit, guys, this is all risk to the upside here. If it's a debit, this line that we're talking about for here would come down to here and be below that line. You would have lost money. All right. All right, folks, that's it. Take advantage of this. 36 bucks will probably save you a lot of anxiety. All right. Because I talk about when, where, and why we set these up. And I build from simple concepts to real life examples for you folks to hopefully help you correlate this in your everyday life so that you can remember it a little bit easier. All right. Smash the like button before you go, please. Comment and subscribe. All right. Last thing. If you can't take that, take it easy. I got you, John. I got you. This one here. This is a normal distribution. So the idea with this, folks, if you guys are sticking around, the idea is right here on a distribution channel. I will learn one day. I promise you. I will learn. Is that it's a 50% chance of this happening, right? 50% chance of this happening or 50% chance of this happening. That's why when we talk about stocks or ETFs or futures, the real nuts and bolts of it is it's a 50-50 chance, positive or negative, from the point that you put it on. Yeah, we try and use technical analysis and all those things to turn those probabilities a little bit because we can see momentum shifting. But really, if you are a mathematician, he would always say it's a 50-50 chance. I don't care. All right. So that's why the deltas on these distribution channels line up. So the idea is the one standard deviation move here is all of these probabilities added up, the probabilities of this happening versus the probabilities of this happening, right? Or you could go even further and kind of throw it out. Well, all right, I want to look at this line. All right, well, this line tells me if I add up this, all this out to here, right? Add all that up, that's the probabilities of that outside of a one standard deviation move, right? So that's about a 16 delta is what we usually kind of shoot it out to be. This is usually around a 36 delta is what we kind of call that out to be. It's a little bit higher than that. I think it's really around a 38. And then the idea is this is a 16% probability here, right? Well, then this is an 84% probability of that happening, okay? So that's how this distribution curve works a little bit. All right, thanks guys for all the questions. I do appreciate you guys keeping me on my toes, making me think a little bit harder, all those things. Hopefully I didn't mind bend myself too much and throw you guys off. If you guys have any other questions, comments, or anything else, I will circle back around for some of you folks that didn't get a chance to watch this live with us. I see there's a lot of people a few minutes back, but I'll stick around after this to make sure everybody's clear concept. All right? Thanks, guys. Appreciate you, John, and everybody else out there. Catherine. All right. Take care, guys. Manu, appreciate it. Bye. Take that.